This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
I'm going to work through Section A of the September 2016 Paper F9 exam. So make sure you've downloaded the questions, you've got them in front of you. And a couple of things before I start. First of all, I will split it into 3 lectures. I'll do 5 each time so that it doesn't get too long. But also 3 general points about Section A, your approach to it, to make sure you've got the best chance of passing. Firstly, don't spend too long on Section A. You should be spending about 27 minutes. Now, that almost certainly won't mean you finish Section A, but you must make sure that you do something for each of the 3 sections. You can't rely, the danger is people spend hours and hours on Section A. In total, it's 30 marks. You need 50 marks to pass, and what you really should be aiming for is to get at least half marks on each of the 3 sections. And so don't spend too long. You can always come back later if you find you've spare time after sections B and C. The second point is when it comes to the end of the exam, you must make sure you've handed in 15 answers for Section A. There are 15 questions. You must hand in 15 answers. Now, almost certainly, there'll be some questions that you don't know the answer to, or that you calculate an answer and it's none of the choices, or you'll run out of time. But those questions you haven't answered for any reason, when there's a few minutes left at the end of the exam, you must guess them. Because guessing, even if you guess 5 questions, the chances are you'll get at least one of them right, and that's 2 marks. And 2 marks on its own is nothing. But if it's the difference between getting 48 and 50 and failing and passing, then it's everything. You must hand in 15 answers. And thirdly, although I'll go through them in order, obviously, because otherwise it'll be confusing. In the exam, do them in any order you want. What I would do is look for the short ones. Leave any big ones initially. Look for the short ones. When you look at number 2, it's a tiny one, in that there's very little reading to do. And those are ones we'll deal with when we come to it, but you know immediately that you either know the answer, in which case tick it, or you know immediately that you have no idea, in which case guess. But, go for the little ones. Some of these 15 are very short, and you can get them out of the way very quickly, whether you know the answer or whether you're guessing. Then you can go back and spend that bit longer on the longer ones, because the longer ones obviously take longer to read. But, they're all 2 marks, and the examiner says some of them are harder and longer, some of them are easier and faster. It balances out. But you've got to make sure you've got the quick ones done first. I said 3 points, a 4th one. Remember, although some of the questions you'll need to do workings, do it in the answer book. Remember, nobody looks at your workings for Section A. All that's marked is the answer. You've chosen A, or you've chosen B, C, or D. So although I'll try and be neat here, so that you can follow what I'm doing, in the exam, don't waste time being pretty. Section C, yes, the long form ones, but Section A, don't waste time writing pretty workings. Nobody will look at them. Anyway, let's now make a start with the first 5. I'll do them in order. So question 1. Look at the requirement first, otherwise there's a lot to read. What is the minimum price per share which the owners should accept for the company? So it's a share valuation. And let's read the detail. The owners of a private company wish to dispose of their entire investment. The company has an issued share capital of $1 million at 50-cent nominal value ordinary shares. They've made the following valuations of the company's assets and liabilities. Non-current assets, 30 million at book value. Current assets, 18 million. Non-current liabilities, 12 million, and current liabilities 10 million. There's a bit more information. The net realisable value of the non-current assets exceeds the book value by 4 million. So 30 million is the book value, but the true value, the realisable value, is 4 million higher. The current assets include 2 million of accounts receivable, which are irrecoverable. So they've got 18 million, but we're not going to get 18. They're only worth, because of the irrecoverable, 16 million. Obviously, it's going to be asset value. And so what are the value of the net assets? Asset, subtract the liabilities. And so the net assets of the business, should be able to do it in my head, but I won't risk it. 34 plus 16 minus 12 minus 10. The net assets are 28 million. However, they want the minimum price per share. So the price per share divided by the number of shares. And one tiny trick here, which is a shame if you fall for it. It says the issued share capital is 1 million. It's very tempting to say, 1 million shares, that's $28 a share, which of course is one of the answers. But it doesn't say there are 1 million shares. It says it's 1 million nominal value. The shares have a nominal value of 50 cents each. And therefore, there are 2 million shares. So for the correct answer, divide by 2 million to get a value per share. And if you divide by 2 million, it comes to $14. So the answer is A. But it's such a shame if you read too fast and divided by 1 million. Because again, it is one of the answers. And 28 is wrong. Number 2. Number 2 is one of those I was referring to earlier, where there's hardly anything to read. And therefore, in literally a few seconds, you should know whether you know the answer or whether it's a guess. Which of the following financial instruments will not be traded on the money market? Money market is trading short-term instruments. And what have we got? Commercial paper, that's short-term, it's on the money market. Treasury bills, short-term money market. Certificates of deposit, the same. But the one that isn't traded, which you should have spotted even if you weren't sure about the other 3, is convertible loan notes. Loan notes, bonds, debentures, they're traded on the stock exchange in the same way as shares are. So it's B. They're traded on the stock exchange, they're not traded on the money market. Number 3. Again, a pretty short one to read, a good one not to waste time on. In which of the following areas of financial management will the impact of working capital management be smallest? An Andrew company is a large listed company financed by both equity and debt. In which will it be the smallest? Well, A is liquidity management. Now that's a major bit of working capital, the liquidity, can they pay the bills? So that's pretty high impact. Interest rate risk management. Well, again, working capital, we're either depositing money and interest rates matter, we've got spare cash, or we're borrowing money, interest rates matter. So yes, that's going to have a reasonable high impact. Management of the relationship with the bank, certainly yes, for arranging overdrafts and things. But D, dividend policy. All right, there may be an impact, the more with money and working capital, maybe we end up with less available for dividend. But that's certainly the smallest one of the 3. So I don't think there's much argument there. The answer is D. What about number 4? Which of the following are descriptions of basis risk? Now, if you're unsure, well, I'll talk through them, but at the same time, do watch my lectures on foreign exchange risk management. This relates to futures, and although you can't be tested on calculations on currency futures, you are expected to be aware what futures are. And so one, it's the difference between the spot rate and the futures rate. No, nearly, but the spot exchange rate and the futures rate are likely to be similar, but they are different. The difference is the basis, but that's not the basis risk. So it's not one. What about two? It's the possibility that movements in the futures price and spot price will be different. Yes. You see, you may have a futures price, I'm not giving a full lecture on this, but the futures may be $1.6 to the euro or something. The spot rate might be 1.55. So they're different by 0.05. That's the basis. But over time, they'll both move. The futures price might move to 1.7. The spot price, though, doesn't have to move by exactly the same amount. It might move to, well, that's not bad. It might go to 1.66. And so the basis, the difference, has changed. And it's the fact that that difference stands to change that is the risk. That's the basis risk, that the difference doesn't stay the same. So 2 is correct. 3, it's the difference between fixed and floating exchange rates. No, that's something to do with, well, interest rates can have something to do with it, but not here. 4, well, in fact, use a bit of sense, although I'll talk through it. Always keep your eye on the choices. We know it's not 1, we know it's not 3, and it is 2. So, in fact, there's only one possible answer, which is C. 2's got to be there, and since 3 isn't, it can't be D. So the answer is C. You know, look out for that in the exam. It can save you time, especially, although we're going to talk through number 4, especially if you didn't understand number 4. You know, we know what the answer is going to be. It's one of the reasons for the difference for an imperfect currency futures hedge. Precisely. It's relating to that basis risk. That, as I've said, without giving a lecture on futures, because there's one on the website, had they moved by exactly the same amount, so the futures went up by 10, spot, if it went up by 1.6 to 1.65, if the difference remained the same, then, subject to, in fact, contract size, but basically you could have a perfect hedge because both the spot and the futures move exactly the same way. Because they don't, because of that basis risk, it's one of the reasons for the hedge not being perfect. So it's 2 and 4, the answer is C. Finally, for this lecture, because I said I'll do 5 at a time, number 5, which is quite a bit longer. So again, in the exam, I probably jumped over it. Why waste time? It might be easy, it might be hard. And come back to it later. But here, in relation to finished goods inventory, and assuming a 360-day year, how much finance will be needed from the overdraft? This sounds like it could be very messy. Let's have a look. Craig has sales of 200 million a year. The gross profit margin is 40%. Finished goods inventory days vary throughout the year with the following range. So inventory has a minimum of 90 days. I'm not going to calculate a figure at this stage, but whatever level of inventory that is the minimum. But there is a maximum of 120. So although the minimum will, throughout the year, the minimum will be 90 days worth, there will be times when they've 120 days, when they've 30 days extra. All purchases and sales are made on a cash basis. There's no inventory of materials or work in progress, so this is only finished goods. They intend to finance permanent current assets with equity and fluctuating current assets or temporary current assets with its overdraft. Now you should know what that means from I think the first lecture on working capital in our series of F9 lectures. But the permanent current assets, that's the sort of base level that's there all year. finance that from long-term finance, from equity, but the extra that there may be from day to day, any extra, finance that from an overdraft. And so what about here? You see the 90 days worth of inventory. Well, there's always going to be at least 90 days. So that would be regarded as permanent current assets. And that'll be financed from long-term finance, from equity. Some days we will need extra. And of course, the most extra we'll need, the maximum is 120. Well, the extra 30 days is temporary or fluctuating. It's only there parts of the year. And so that is your temporary or fluctuating asset, and that will be financed from overdraft. The question wants to know how much finance will be needed from the overdraft. Well, enough to cover those 30 days worth of inventory. So what will that come to? We know what the total sales are a year, but of course inventory is valued at cost. Well, if the gross profit is 40%, sales less the cost must be 60%. So that's the cost of our sales for the year. We want to cover 30 days worth. Well, with 360 days in a year, 30 over 365 gives us how much? 260%. 30 over, stupid me, I said 360 and then wrote down 365. Sorry. Start again. 60% of 200 times 30 divided by 360 is 10 million. Yeah, it is one of the answers, so the answer is A. And incidentally, although I said 360 and then managed to write down 365, be careful there. I don't think it was this question, but in one other question recently, the examiner's comment, or one of his comments, was that although the question specifically said 360 days in a year, a lot of people had used 365. And I'll say I don't think it was this one, but the question it did refer to, you ended up getting a wrong answer. You know, I know it happens when you're rushing, but that's the sort of thing to be careful of. Anyway, I said I'd break it into 3 lectures, so we've done the first 5. In the next lecture, I'll go through the next 5.